Good afternoon, everyone. My name is Stephen Abernathy, and I, along with my co-host, Matt Daly, will be your host today. Let me welcome you to the Abernathy Group Family Office's 2025 First Friday meeting. In this meeting, we're going to focus our discussion on 6 truly important questions that have required answers for all intelligent investors. As we've been warning for some time now, 2025 continues to promise significant volatility, and we believe will eventually culminate in a return to more normal valuations. However, as we've said numerous times, most public markets are priced for perfection, speculation is abundant, and policy is changing rapidly. There is a recipe for this trouble, and it's the reason that each of you have such a large position in sort of 45% to 50%, or even in some cases almost 60% U.S. Treasury bills. And I think most of us are glad that we have that liquidity for several reasons we'll go over later. Today, our prepared comments will be recorded, as other families who cannot attend have asked us for the recording. Our comments today will be approximately 40 minutes long, leaving us plenty of time to answer some questions from everyone on the call. And if questions arise from the content of today's presentation, please feel free to either send them along by typing your question in the chat box at the bottom of the screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the icon at the bottom of the screen, and we'll find you, and you can have a commentary with us, please. Our intent has always been to make this monthly presentation into a town hall type of meeting, because we really do realize our comments may create related and at times unrelated questions. And above all, the primary intent of this meeting each month is to ensure that everyone's questions are answered with sufficient data, while attempting to avoid any kind of bias, politically or otherwise. So we want to encourage you to send us your questions, as it's likely that others may have the same or somewhat related questions, and in short, it makes the discussion more interesting. So please, just ask if you have one. One final note, remember to mute your device's microphone and stay on mute until you have a question, as the background noise is distracting. And by the way, as I always put a quick plug in, if you haven't been to our website lately, please consider visiting. There is a wealth of information and content on the website. We and/or Matt does a really good job of adding the research reports that we write, along with summaries of each First Friday meeting going back years. So, and that's called our footnotes publication. In short, I also wanted to add a quick self-serving public announcement that I did last time and the time before that, or the meeting before that also. We recently started the first 401k plan consulting firm sponsored and funded by a family office. And we did so philanthropically, not like Sam Altman built his philanthropic organization, but we really did it with the goal of fixing the 401k plans in the United States. And the bottom line is that this firm will fix your 401k plan for free, while offering each employee education they need to make intelligent decisions about their future. Our goal is to transform the staid and boring 401k plan from a cost center categorized by most of the CFOs in the nation into a benefit that will increase employee retention and help recruit new valuable employees with the ability to retire on time and with the dignity they deserve. So, with that said, let me turn it over to Matt Daly, who's going to oversee today's presentation.
Thank you, Stephen. Today we're going to be covering a number of topics. First, we will discuss some of the things we think the market may be getting wrong. The most prevalent in the current news cycle, I think, would be on everybody's mind as tariffs. But we will also spend a little time on energy demand as well on that topic. Next, we will present our analyses on the possibility of recession and the potential causes, effects, and the level of severity, transitioning that into the family office's stock market outlook for the next 5 to 10 years. After that, we will return to a consistent theme we have been touching on for the last several months, and the primary focus of our March webinar, which is artificial intelligence. Then we will discuss global diversification. Is the US slated to outperform other markets, or are there markets we should be paying attention to outside our borders? And lastly, we will tie it together by asking what the next big technological revolution will be after AI. This you may find has a global slant and definitely broad implications. So, with that, I'll begin. Stephen, what is one thing that the market is potentially getting wrong right now, and what is being said about it, and what is really going on? Are there alternative outcomes not being widely considered in your view?
Yeah, I think, well, certainly topical for everyone on this call and everyone who sort of has a heartbeat over the course of the last month has been worried about tariffs. So, um, most people don't understand that from the late 1800s through and including the first decade of the 1900s, and this was a 30-year or 40-year period. The U.S. had no income taxes, and we had trade tariffs on almost everything coming into the United States. So, if you want to write that off to history, you can. It's just an example that I think it's important to understand that we trade tariffs um, paid for our balanced budget and allowed us to have no income taxes during the late 1800s and the early 1900s. So this is not to say that the tariff discussion creates a certain future as much as it has changed since 1913 when the tariffs enabled the U.S. to run a trade surplus. So it's different today for sure. However, what we can say with a really high degree of certainty is that the tariffs recently imposed by the current administration are meant to be reciprocal. Lots of arguments about the math that goes into that. Lots of arguments are politically motivated. Um, but if you have you know, I guess what I mean is that I know that the current administration is aiming to have or to equal tariffs that the rest of the world is charging the US for access to our country's citizens and our markets. So if you believe that, if you believe that they are trying to impose reciprocal tariffs on the rest of the world, um, then that's something that I wanted to sort of comment on just for a second. So I want to get away from all the political discourse around this concept of reciprocity. This conjecture is as politically armed as any I've heard since the Trump Biden campaign. And as you know, we'd like to avoid this political argument and stick to the facts. So you can make your own decisions about the tariff structures the current administration has imposed. So, firstly, the facts. As we discussed in last month's presentation, the U.S. collects approximately $80 billion per year in tariffs. 80 billion. The U.S. pays over 600 billion per year in tariffs to other countries, despite importing more than 2 times the amount of goods and services that it exports. So when you start to do the math with this, you find out that we're really paying 4 or 5 times the tariffs that we're collecting. That might be okay for a small country, but we're the dominant country on the planet. And if anyone on this call thinks that it's fair that we pay 4 or 5 times the tariffs that we charge, understanding, uh, keep in mind, understanding that the US has also been responsible for the protection of Europe, Mexico, Canada, and more than 20 other countries over the last 75 years, please give me a call so you can explain the math to me because and this is not, I'm not trying to be argumentative. I'm just trying to be, and I'm not trying to support the administration or detract from the organization, from the administration. I'm just trying to understand another point of view, and I'm not trying to make a political statement. I'm just trying to make a statement of logic. The strongest country in the world, it seems to me, should have an even playing field when it comes to global trade. And and by that, what I mean is equal to the tariffs the rest of the world is charging the United States. You know, it should be equal for access to our country's citizens. So I think a quick summary of what, well, let me just stop there for a second. And Matt, I know that you've studied this way more than I have, and you may have some really concrete comments here. So any comments that you have that might help any of us on the call understand maybe a different attitude or more strong attitude towards this?
First of all, on the politicization, if you will, of this issue, I think it's important to note that this is this policy has been floated by both sides over the last several decades. In 1996, Nancy Pelosi gave a floor speech um, calling out the ridiculous imbalance of tariffs between China and the United States specifically. And then in 2008, Bernie Sanders did the same thing. So this idea has been floated at least once a decade for 40 years, maybe more. Um, and the idea behind it being that it supports working class and blue collar Americans and reshores things, industries, and it boosts domestic production and creates jobs, et cetera, et cetera. One thing I do want to mention also to take the other side is just something that I thought was interesting that I read this week is the economist Thomas Sowell. I don't know if you're familiar with him, but he mentioned the example is the only real example that I can think of in recent history. You mentioned not having income tax during that period in the early or late 1800s, early 1900s. And then in 1922, there was the Ford-Niebuhr Tariff Act, and that increased tariffs. And then, during the 1920s, obviously, we had a period of tremendous prosperity prior to the Great Depression. And then after the advent of the Great Depression in 1930, I think it was the Smoot-Hawley Act, we further increased tariffs. It was supposed to be to develop jobs. And a lot of people, I think, would say on that point, it further exacerbated the Great Depression. Um, but back to what Sowell's point was about the tariff acts in the 20s and 1930 is that, and the concern here with what the current administration is doing, if there is a concern, just to point out if there is a level of uncertainty, if this is being used short term, being used as a negotiating tactic to bring better terms for American producers, then I think it's probably okay. I think people would probably agree that that's a good thing. If the policy framework is done through trial and error and implementing one rate, and then if it doesn't work, we try something else. Sowell said that this kind of uncertainty may encourage some countries, some individuals, investors, etc., to pause and hold their money until after they feel comfortable with the future outlook. And this, of course, would not be a good thing. It could lead to or contribute to a possible recession if people are being sidelined essentially because of volatility or uncertainty.
Sure,
Just
sure. I want to add a tinge more opportunistic comment here. I think that it's unarguable that the United States is the strongest country in the world and has been since World War II. And this is a point that you made when you and I were talking earlier this week. And, because we were the strongest and the most profitable country in the world, the calculus clearly tells me that the rest of the world has been benefiting significantly from our charity. Maybe charity is too strong a word, but from our largesse or from our oversight or from our protectionism. And all that's good and well. Maybe it's even fair and just that the strongest take care of the weaker. However, for this oversight and charity, it seems reasonable for the U.S. to at least have an even playing field, described as what we tried to describe as a reciprocal trading framework. We certainly, I don't know, we certainly admit that there's more at play than we may be embracing. There's a lots of negotiation here, and Trump fancies himself as a negotiator. However, tariffs are designed to change economic behavior. And whenever you change economic behavior, there's likely to be pain. It's the same thing as one of the families we were having a long discussion with this week. When you have tennis elbow and it bothers you for 3 years, if you want to get it fixed, you have to have an operation. If you really want to have it fixed, and then you have to go through 9 months of physical therapy, which is a real pain. I mean, there's pain to fix things. We want to remind every investor on this call that humanity is intelligent. And as an example, obviously when steak is materially more expensive than chicken, we substitute chicken for steak and we live through it. When foreign made cars are more expensive than American made cars, many Americans will buy American made cars. That's what we're trying to incent. When American pasta is when Italian pasta, for instance, is more expensive than American pasta, we wait a minute. That's a bad example. We're not going to substitute American pasta for Italian pasta, guys. Sorry about that. But the kidding aside, tariffs are created to change economics. They're effective over the long term. And without being political, the current administration is trying to create an even playing field, despite the fact that we're the strongest country in the world and we could demand preferable access to our U.S. consumers, as the American consumer is among the strongest in the world. We do lots of things poorly as American consumers, but one thing we do is we spend. In summary, so as we've been saying since December, in each presentation, each month, this administration does not offer uncertainty. I just want to be very clear about that. It is certain. They want the world to change. They want an even playing field. Each person on this call may or may not agree with the negotiation tactics that the current administration is taking to achieve this goal, or they may not agree with the math they're taking to define reciprocity. However, it's pretty certain to me that they're going to pursue this agenda Trump and his trade advisor, Peter Navarro, have been touting and again, they've been touting this for more than 20 years at almost every opportunity. Equal trade first, then free trade. So, Matt, if I've overstated anything, or it sounds like I'm being a supporter of one side or the other, even me out here.
I don't think so. I think it's right because, like I said, this has been touted by both sides for decades. Uh, I think, I'd have to go back and look at the policy discussions and, read the transcripts, but I would imagine all of these imbalances were put in place either to geopolitically leverage a country away from trading with an adversary. For example, we go to Thailand and Vietnam, say, we'll pay 40% tariffs. You guys only have to pay 2. Stop selling your stuff to China, sell it to us, and start buying our stuff. Part of it is, like I said, geopolitical leverage. Other parts
It's fair.
to help develop a country's
It's
manufacturing
fair.
sector so that they become a better trade partner in the future. So I'm sure at the time it made sense to set up these drastic imbalances. Um, but that time, I think, is expired, and it is probably is long, more than 10, 20 years overdue. We've let this kind of just fester and not address it. And I think, it's the longer you wait, the more painful it is to address it, but it has to be done at some point, I think. I just
I,
Otherwise we're subsidizing the economies of everyone else in the world, which is, I don't think, in the best interest of the American taxpayer.
I, uh, I hate to agree with you, Matt, but I do. I deeply agree with you. Okay, so if anybody has more comments or wants to really discuss, or if you have different math or different ideas about the tariffs, please do take a minute and give me a call. Let me move on real quickly to energy demand because the energy industry is the lifeblood of our economy. If we run out of energy, if we run out of electricity, um, everything in our world stops. Just think about that for a second. I live in a very dense populated city, and if electricity ran out, or if we ran, if our grid blew up, it wouldn't be more than 2 or 3 days before there would be utter anarchy. Um, for our lifestyle, energy is almost as important as oxygen. And for global defense, think about this: energy availability is going to define who's able to defend themselves during war and peacetime alike. We had a family office member attend one of the most important annual utility conferences this month in Dallas. So this is not insider information, but it's it's incredibly up to date information, and it's, to me, shocking. There were many, when we downloaded the summary from the conference, it was about a week long. There were many incredibly important takeaways, too many to bother you with. However, there was one huge variable that I think is definitely being misunderstood by the capital markets. Energy demand for the past 50 years has mirrored population growth, basically 1 to 2% per year. So just keep that in mind. That is the rate of growth per year and it's just based on demand, energy demand. This meant that the utility industry was a slow growing industry. Everybody knows this. Consequently, it it was the type of public security most owned not for growth investors, but for dividend distributions. While the market is pricing in 2% growth, the insiders or those running the utility companies themselves, our information is that they are now plotting for demand for nearly 10% per year growth for as long as they can reliably have estimates for. So this is this is an earthquake level change for energy demand. It is it, and I will tell you that there was sort of uh, there's fear in the energy industry or in the utility industry, you know, and it's not only from data centers. So most of you would say, okay, data centers. So are they being overbuilt or not? We're going to address that in just a second. But 20% of the increased demand is coming from, increased manufacturing plans that are already submitted, and 20% of the demand is coming from EV demand, and the rest is coming from any number of lifestyle demands, as every portion of our existence kind of depends on energy these days. And so it means that utility industry may become valued differently. It could really become a growth industry. So I want each of the families that we're talking to, that we're serving here, to know that the energy industry or the utility industry may not be as sleepy as most people think. Either way, the market isn't aware of this, and I urge each of you to on this call to consider the first order effect of increased demand for electricity. I then ask you to consider the second and third order effects of this demand growing from less than 2% per year over the last 50 years to over 10% per year. Understand the demands on the natural gas industry, which is the only industry that will be able to satisfy this energy demand. And equally importantly, down the line, the nuclear power industry. Also, as sort of a third order effect, or maybe it's a second order effect, the infrastructure we call the grid, it is incapable, and understand what I'm going to say. The grid is incapable of carrying, of increasing the energy being transported from point A to point B from 2% to 10% per year, if the utility industry is right. Um, there's they can't do it. It cannot do this. So, Matt, sorry for the long-winded uh, reply on energy. Yet I wanted to make sure we pointed out areas where the market is clearly, wrong about expectations and consequent pricing. Any follow-on comments from you on that matter? You're on mute.
My apologies. No, nothing to
That's right.
add. No comment to add there. Just that when when you've told me about that, I've found it really intriguing. I
Yeah,
haven't heard anybody else kind of talking about that.
it's it is shocking to me, but anyway. Next.
Okay, so the next question, what is the probability of a recession? What are the drivers, and what could we expect from the markets over the coming years?
Okay, we'll try to get this one fast because I think
Mhm.
I'm sorry to have spent so much time on the tariffs, but I thought it was important. So the recession probability is increased for certain. Absolutely. Not only has the Atlanta Fed lowered their estimates to right about 1% to 3/4 of 1% to 1% for GDP. However, you know, whether we go into a recession or not, there's no way to determine how deep or how long this recession is going to last. So the probability is increased. It's probably at least a coin flip from here. We've been worried about it for a long time. We just couldn't figure out what the event would be to push us there, and it looks like this tariff fear, which I think is largely unwarranted. I I strongly urge you to consider this as being unwarranted, but I think that I think this is the narrative that's going to change. So, as we've consistently discussed for more than 12 months, the debt load for the United States, for corporate America, and for the U.S. debt load, corporate America's debt load, and the citizenry, it's going to play an important role in the length and the depth of the recession to come. The indicators to watch, which everybody wants to know, it's employment. If the employment number moves up, it's a signal to expect a longer recession. Counterbalancing that will be interest rates and the strength of the dollar. So if interest rates move lower, this will lessen the recession's negative impact, and it will also offer us a faster recovery. So just keep that in mind, that there's recession indicators and then there's counter recession indicators. So keep your eyes first on employment, second on interest rates, and at the same time, it will be important to keep your eyes on bankruptcy rates, because once we move into that phase of the recession, it's probably closer to the end than most people think. However, it's scary. We do expect bankruptcies to increase. There's a lot of leverage that took place when we had 0% interest rates, and we expect these bankruptcy rates to move towards record levels experienced in the past. If we if we avoid this economic likelihood, our recession will likely be shorter and less damaging. However, the question that was the attendant question is it likely to be as bad as the great financial crisis of 2007 and 2009? And the answer is we just don't know. And I know that's not comforting to a lot of you, but I don't want to give anybody any kind of fake or false certainty. You know, many of the first order effects are still unknown as to whether we're going to have a recession or not, and how long and how deep. The longer it is, the worse. Um, or the deeper it will be. And the third order effects of the domino chain are completely unknown today. So, in short, probability is increased, lots of variables to play. Um, we just don't know yet. But I would prepare for the worst and hope for the best. Matt, any more comments on this?
No, I'll curb my comments in the interest of time. We can move on to the stock market.
Got it. Okay. What's our base case for the stock market over the next 5 to 10 years? And this will be important for most of you who follow us. The base case is the same today that it's been since 2023. And I know I sound like a broken record, but our analysis then is only gathered more information that supported our thesis. The public and private markets remain overvalued. That's clear. Speculation is rampant. That is also clear. Leverage is at record levels, leaving, uh, you know, leaving many investors with much fewer or many fewer alternatives than normal. That is also clear. So we're either going to have a significant correction, which will bring back our public and private valuation markets to a valuation level which allows investors to expect more normal returns. So either a large correction or we'll have a period of 5 or 10 years where the market narrative continues to vacillate from euphoric, never ending growth, no price is too high to pay, to suicidally negative, which will drive markets higher and lower, confusing the investment world to the point of almost giving up trying to invest in the public and private markets. So these 5 to 10 years, we believe, are going to leave the market approximately where it began in 2023. So this is why we've rebalanced everyone's portfolio to avoid seeking appreciation in an overvalued environment. So there's not one portfolio that we have that is in any way aimed at appreciating or benefiting from appreciation. I think most of us on this call today, if not all of us, are glad that we've got 50 to 75% of our investment allocation aimed at the high quality dividend and income generation. And it also allows us to wait until the markets offer us the ability to invest at levels that allow us to expect a reasonable return relative to the risk that we're taking. I wanted to remind you of this, and Matt, before your comment, um, our base case, as I said earlier, is either a significant correction over the next 5 or 10 years, which will bring valuations much lower, and it will offer us a buying opportunity, or we're going to have a significant correction, or a period of 5 to 10 years where the market narrative continues to vacillate from euphoric to suicidally negative, driving markets up and down, but basically leaving us where we started in the beginning. So we don't have a crystal ball, and our insights really are based on historical outcomes when markets were similarly valued as they are today, and it's shown in this current slide, which documents at least 4 periods over the last 125 years where our capital markets moved both up and down, giving everyone agita, yet ended the year or ended the 5 or 10 year, and in some cases, 20-year returns with no return for investors seeking market appreciation. And don't forget, each of these periods began with an overvalued market coupled with a narrative that convinced the world that there's no limit to growth. Risks have evaporated and conventional investing wisdom is dead. So, with that said, Matt, any more to add to this topic?
No, I think you covered it nicely, and I think the consistency of that viewpoint over the last significant period of time is indicative of, you know, that being well covered.
Gotcha.
Let's move on to the next topic. Another one we've covered pretty well recently. So much attention is on artificial intelligence. Are we overbuilding it? And is there potential that some of the companies that look like big winners right now could end up being big losers?
Yeah. So I think the market is couching this in the wrong with the wrong question. I think the question is not whether it will be useful or whether AI is being overbuilt or not. I think the question is um, whether we'll be able to generate a return from the money being spent. That's the big question that people have forgotten to ask. So the question is not whether we will use the infrastructure needed for inference, meaning inferences answering the questions that you pose for AI. Um, that's very similar to saying that similar to the 1990s when the internet was being built, few understood that the world was spending money on infrastructure that was going to allow us to fast forward over the next 20 years. Um, and and today, obviously, the internet is so much a part of everyone's life that if the internet goes down, everyone from my firm all the way to my family comes yelling to me as if there's a critical accident and they're in need of emergency aid. They can't go on with life without the internet. It's it's kind of funny. The more relevant question for all of us is, again, as I said, how will a return on investment be delivered? It's not clear to us yet. So my short answer to your excellent question is yes, we are overbuilding today. The firms um, that are spending the hundreds of billions of dollars on infrastructure are likely to be sorry. At some point, there's going to be a point in this chasm of lack of narrative and of non-believers, and they will have to prove that there is value on what they've spent, or they're going to have to write it off. Just don't forget, during the internet build out, there were scores of companies that had to write off their investment in fiber and everything else that they were doing. Um, However, over the longer term, the extra power demanded, the upgrading of our grid, and the collective intelligence bestowed upon humanity is going to have an incredible returns for lifestyle and progress on topics like decarbonization, for example, or the eradication of diseases. Um, it's coming, but we are overbuilding, and I think we're going to be sorry at some point in the fairly near future. Matt, do you have some more comments on this?
Just to draw one quick parallel back to the 90s, since you mentioned it, I think the way I look at it, and it's so much of the attention is on the chat GPTs and the Geminis, the large language models. I would equate it somewhat similarly to search engines in the 90s. I think it had maybe the broadest use case for the average person. But we figured out we don't need 10 search engines. I think we'll
That's
figure
right.
out the same thing with the large language models. I'd be more
Right.
interested, I'm more, frankly, more interested in AI's ability to create efficiencies in business processes and manufacturing, et cetera. And I guess I don't know the data on it. I'll have to check it, but I would, so much of the percentage of dollars seems to be going to the chat GPTs of the world. I think it's probably better spent elsewhere.
Well said. Really well said. Better than me. Yep. Thanks, Matt. So let's get on here. So this is a question that I hear all the time. Why spend our money on globally diversifying when the United States is going to be the only horse in the race? The main question before us today is not whether we should be diversified in global allocation regarding all countries, despite what we think of these countries at these moments. I think the reason I think the reason that you shouldn't pass judgment on on 150 different countries on the globe is economies change. Countries have new administrations, new ideas, new resources, and these changes are absolutely impossible to predict. We all have lives. We can't keep up with, you know, over 100 different countries throughout the world. The question is whether the US, with its currently overpriced market, is worth the overvaluation being demanded relative to the seemingly slower growth, yet higher dividends being paid by non-U.S. countries around the world. And I personally think I actually feel very strongly about this. It's impossible to know the answer to this. So our position on this is, as we've always discussed from every one of you singularly and many times before, the old saying, the more you know about the future, the less you should diversify. The less you know about the future, the more you should diversify. For instance, if in a crazy example, if you have insider information and are completely sure about the announcement coming in the morning, you should have the vast majority of your assets in the target, which will prosper based on that information. This is an easy decision to make, although it might land you in jail. So don't invest based on insider information. We're not supporting that. We're just trying to make a point. In short, we don't know, nor does anyone else in the world, what will happen globally over the next 10 or 20 years. Here's what we do know, and that I want each of you to remember about diversification. India looks a lot like China did 20 years ago. I've had lots of conversations with many families that invested in India 20 years ago, and they still bear a grudge. India has the largest population on the planet. China is shrinking. It's a capitalist country. India is hungry and believes in merit, meaning if you work hard and you make good decisions, you're likely to prosper. India is also incredibly well educated and smart, and they value education. It's not performed well over the last 20 years, which has convinced many that it will not perform. And again, there are many negatives associated with the investment case against India, and we can go through them privately if you'd like to. There's a lot of them. What we believe is, I think, unarguable. I think that everyone needs to be diversified because we truly don't have a crystal ball into the future. And here's the most important aspect of understanding whether you're diversified or not. And it's both serves as a litmus test to understand if you're truly diversifying or if you're just kidding yourself. When you adequately diversify, you always have an asset class or two or three that is underperforming the market or actually losing money. So if you've got a portfolio and everything is making money, you probably aren't diversified well enough. I know that sounds counterintuitive. I realize no one wants to lose money as a cost of diversifying, yet diversification means non-correlation. It means zigging when other parts of the market are zagging, and done correctly, it reduces volatility, and reduced volatility increases returns over time. It's just math. So the more you know, the less you should diversify. The less you know, diversify more. The long-term goal is not to lose money, and diversification is a key variable in this goal. Matt, any any more comments to that sort of?
Yeah, just a few more kudos to India. They have just a couple things to note. Demographics wise, I think you can really do a lot, especially now where uh, way more than half of countries are declining population and have negative population models. Um, India, the median age is 28, so they have a massive youth bulge, and that positions them for high levels of productivity past 2050.
Great point.
Um, Also, differentiating from China and how they could be potentially a faster growth model than China in the early 2000s is they were the world's cheap labor. Not that India is not cheap, but they have a diversified economy. First of all, their manufacturing sector is doing higher grade goods like pharma and semiconductors, whereas China is
Yes,
making, cheap clothing and cheap electronics.
good point.
And they also have a diversified economy where they have a significant services sector. And if you've called the Fortune 500 companies customer service recently, I'm sure you talked to somebody in India. I think that gives them a better chance. Plus, their STEM abilities and education. They have a large English speaking population. There's just a lot of interesting pieces there that position them pretty well going forward.
Well said. Yeah.
Also, just one last thing, sorry, just not to overdo it, but they're also geopolitically pretty neutral. They get along with almost everybody. They don't have any kind of adversaries other than Pakistan, I guess, with the
It's a
conflict
great
with them.
point, and there's another saying that I think always rings true, and that demographics is destiny. And if you're growing demographically, you likely have a brighter future than if you're shrinking. Okay, last quick topic. Um, Matt, you have anything to introduce it, or you want to just launch in?
Um, Let me find my place. I do not. Go right ahead.
Okay. Here's my favorite topic here for the day, and hopefully each of you will enjoy this as much as I do. So, for those of us who relentlessly research this topic, it's clear that the next disruptive technology, which is on the back of AI and our society, is the movement of agents coming on the scene. So, what do I mean by agents? Agents are nothing more than artificial intelligent robots, which actually achieve a goal for us. So, it's not a physical robot, it's a software based or digital robot. So, think of it this way, incredibly oversimplistically. As we gave you an example last month, um, AI provides the information or the answer to the question, agents actually carry out the procedure. So this example that we used last month was, if we want to schedule a visit to the wine country in Sonoma Valley, and you want to visit a certain type of winery and a certain type of restaurant, and you want to stay at a certain hotel chain, an agent can find the locations, make the reservations for you, make the decisions for you and the times, set the times. It just saves time and potential frustration. And that's an overly simplistic now idea for just an agent. Agents can also help you build software programs that you can't build, that it would take you a month to build. They can do it in minutes. So for those of you looking for the next layer of hype and gold rush, like narratives, it's likely to be the agentic revolution. It's coming. So keep your eyes open. However, for those of you who really want to be on the ground floor of the next earth shaving or earth shaking revolution, these are those of you who want to really speculate with a small portion of your money and buy NVIDIA at $1 per share, understanding that, I mean, make sure that you understand that there were 50 NVIDIAs all trying to build the next generation of semiconductor that would change the world, and the vast majority of them lost the battle, meaning they went to zero, they're out of business. It's the next life-changing technology will be quantum computing. Just understand that. It's coming. Is it now? No. Is it 10 years away? I don't think we know. Will there be one winner or will there be lots of winners? I don't think anyone knows yet. But quantum computing is going to change everything. Just as a quick reminder, your passwords, which today may take, you know, a month to solve, they can solve it in 1 nanosecond. So, you know, what we don't know is I, I I don't think we know what changes the quantum computing era will have on the world in which we live. For those of you with 10 to 20 years to wait, it'd be wise to start your research now. For those of us who are not interested in investing in companies that are losing money currently, um, we should focus on other things. Matt, I know we're running a little bit late, but you may very well have something that I've overseen or overlooked. What's going on?
Yeah,
Anything?
just really briefly, I just want to explain what quantum computing is at its most basic level for anybody who's not super familiar with the
Definitely.
topic. Um, so quantum computing is the fundamental building block of a quantum computer is a qubit, what they call a qubit or quantum bit, right? Unlike classical bits, which are, your traditional computer is built on, classical bits are either a zero or a one. And a qubit can be in a superposition, meaning that it exists in a probabilistic combination of both zero and one at the same time. So imagine spinning a coin on its edge. It's neither heads nor tails until it lands. And similarly, a qubit holds a range of possibilities until it's measured, which just opens up the door for so much more capability. And that being said, Stephen alluded to this already, but it will change the world in ways that we probably can't even imagine right now, but definitely in ways we can in terms of drug development, pharmaceuticals,
Yeah. Great
efficiencies
point.
that will just blow our minds. It will, and it'll supercharge
Great
everything
point.
that we do. It'll supercharge AI, language models, everything to do with AI, and just it'll create efficiencies that will completely change the world.
Great point. Great point. And it's a little scary.
It is.
Okay, guys. So everybody, thanks for tuning in. Again, if there are questions, Matt, are there any questions that you've seen on the bottom?
Let's see.
Anybody come in? Just want to make sure
One
we don't
second.
leave
I do have
anybody.
some comments in here. Let me just get through it. Nope, no questions.
Gotcha. Okay. All right. Thanks again for tuning in. And if there are any questions, attendant, just give us a call after this. Have a good month. Bye now.